Welcome back to GPA Factory and managerial accounting concepts. And in this one, we are going to talk about types of companies, but bring it up for a second time. So when we say types of companies, we're talking about service companies, merchandising companies, and manufacturing companies. And manufacturing companies are going to be what we primarily focus on. And the real reason that we're bringing it up again is to just re-cement it into your brain before we introduce this idea of manufacturing companies and the three different types of T accounts. So when we think about service companies, the product is intangible. As a result, we have no inventory. So product costs are going to be labor, materials, other utilities, things like that for manufacturing overhead. So doctor's office. Decent example of a service company. Okay, merchandising company. We resell tangible goods from blank in ready to sell form, purchased from suppliers or wholesalers. Okay, one other decent way that you can think about that. So suppliers or wholesalers. So one inventory account is just going to be merchandise inventory or just inventory. So it's really all final goods. So the product costs are going to be the purchase price from suppliers plus any shipping costs, important tariffs, cost to get the product ready for sale. So there might be two subtypes, right? Retailers sell to customers. Well, I'll say end customers, like you and I. So retailers, like when you go to a store, versus wholesalers, they sell to retailers. So merchandising companies, you can think about like Ford, any manufacturer. Nope, not Ford. Walmart. I'm thinking about merchandising companies, not manufacturing companies yet. Now we're getting into manufacturing companies. We actually produce the goods from start to finish. We might sell goods directly to end consumers or to merchandisers. So we think about B to C or B to B, right? B, this is just like kind of vernacular in the real world. B to B versus B to C. So B to B means a company selling business to business. We are selling to other businesses versus B to C is a business selling to consumers, to end consumers. For manufacturing companies, we've definitely introduced these ideas of the manufacturing costs or inventoriable costs or product costs, all used interchangeably: direct materials, direct labor, manufacturing overhead. This is the one that we're going to care about because of the T accounts and the costs moving through our inventory T accounts over time, which we talk about on the next page. I promise we are going to bring it up. Okay, so some examples of manufacturing companies. Now, Chris, is the time to write out Ford. There you go. So Ford actually produces its trucks to then sell them. So Ford would be an example of a manufacturing company, not a merchandising company. So the three inventory accounts: raw materials, work in process, and finished goods, which we will talk about on the next page. And often we are going to be dealing with manufacturing companies in this class unless we are otherwise told. But let's jump in and talk through our three inventory accounts. Very, very important, especially when we bring up this idea of job costing. But I think that early on in the class, it's better to start with this earlier rather than later. At least get our feet wet with it. We understand what ending balance is and how to use these T accounts. If you did not like T accounts in financial accounting, that's totally fine. I think that this is extremely helpful. There are some ways that you can, let me just kind of skip ahead a couple of pages. You can kind of forego using the T account stuff and just use equations. I think that this is much more challenging and does not help you visualize what the hell is going on. So I'm for sure in my videos going to work with T accounts a ton. Okay, T accounts a ton. So here we've got three inventory accounts for manufacturing companies. We've got raw materials, we've got work in process, and we've got finished goods. Raw materials, work in process, finished goods. But let's map to like what this actually means in like a real example. So let's say that we make surfboards, right? We make surfboards and we're going to need to buy some like foam and epoxy to like make the surfboards. So we got to buy some like foam and epoxy to make these surfboards. Well, first we're going to buy all of those raw materials and we're basically going to put it in the middle of our factory floor. Okay, it's probably going to be organized in like a nice closet or in some sort of like storage room or something. But for the sake of our brain, just seeing like, trying to visualize what this might look like in practice, we're going to take all of those materials and they're just going to be in the middle of our shop, right? In the middle of our factory floor. But we do buy them and they go in the middle. That's those materials in raw materials inventory. Then, as employees start to work on making the surfboards, they are going to go over to the middle. They're going to grab some of those, materials, and those materials costs are going to flow into starting to be worked on, right? Work in process. So those material costs flow over into the work in process inventory account. And then as those things are being worked on, so it's called requisitioning of those materials, but as those things are being worked on, there's also labor that's being added, right? So that's, not inventory because we don't go to like our closet of people to be able to like, hey, we're going to take out this person and we're going to put it toward starting to make these surfboards. No, but the labor is added as a cost, even though it's not like coming out of a different account. But we are going to add labor. We're going to add some manufacturing overhead, but those are all the costs, the product costs that get added to work in process inventory. So we've got some direct materials that's coming from raw materials. We're adding some direct labor. We're adding some manufacturing overhead. We're working on it. It's in the middle of the factory floor and it's starting to look like a surfboard. Then we've got that surfboard and it is done. That means that it moves over from work in process over into finished goods. Okay. Let's start to actually write out what some of these items are. So we might have a beginning balance in this raw materials inventory. We are going to add purchases of raw materials. We're going to add purchases of raw materials. We might have an ending balance in raw materials. And then as we use it up, this is going to be raw materials used in production. That's when they go over into work in process. I want you to think about out on the right, in on the left, okay? Out on the right, in on the left. So it comes out on the right and it goes in on the left of work in process. So again, with work in process, we might have some surfboards, so beginning work in process, some surfboards that we started the period with. That's going to be our beginning inventory. We're going to add direct materials. We're going to add direct labor. And we're going to add manufacturing overhead. Those are all of the costs, right? This direct materials is coming from raw materials. We add some direct labor. We add some manufacturing overhead. We might have some ending work in process, or we're not quite finished with it yet, so it's not going to go over into finished goods. And then there's a very specific name. I'll just write COGM, cost of goods manufactured. That's the amount that we finish this period that moves over into finished goods. So it's that same dollar amount, cost of goods manufactured. Okay, so the cost of goods manufactured, this is the value of all the goods that were blank this period, this finished or completed or manufactured. So it's a very specific number. It's how much is moving from work in process over into finished goods. Very important kind of terminology thing to keep down there. So it's again, what moved from work in process to finished goods this period. This period. And then really there's one other, it's not really an inventory account, but here we might have, our beginning balance in finished goods, right? Beginning finished goods, we add that cost of goods manufactured. We might have an ending balance, ending finished goods, but then the amount that leaves finished goods and where it goes is that becomes cost of goods sold. So cost of goods sold means that we have finished those goods. They were surfboards that were just hanging out on the shelves. We've actually sold them now, so then that goes over into cost of goods sold. Okay, cost of goods sold expense, the value of all the goods that were sold this period and what moved from finished goods to cost of goods sold. Other note, so raw materials, work in process, and finished goods, these are on the balance sheet because these are all inventory accounts. Inventory. When items are sold, they would then move to cost of goods sold expense. That's on the income statement. Okay, freight in, so like shipping to get it to us, import duties and tariffs, anything else needed to get the materials that are ready to be used are going to be included as raw materials inventory. Okay, shipping and delivery costs to get finished goods to customers do not go into inventory accounts and are considered period costs. Shipping and delivery costs to get finished goods to customers. That's after they're already made. Okay, that's after they're already made. We would be sending them off to customers. Okay, we're going to do a concept check here to make sure that we understand what's going on. We're going to put all this into practice with Surfboards R Us Company. We have the following information regarding to 2029, first year of operations. We started with 0. We're going to consider that all raw materials is direct materials. All right. We're going to start with, in these questions, I really do like to start with raw materials, work in process, finished goods, and cost of goods sold. And then there's really one additional piece here where we've got manufacturing overhead. We will get a lot more detailed with this as things go on, but still kind of remember that same thing, out on the right and on the left. You're going to hear me say that a lot as we move through here. So we've got all of this. So beginning raw materials, beginning work in process, beginning finished goods, 0, 0, 0. Let's just go ahead and write that in. It's not always going to be the case, but we've got beginning 0, 0, 0, and we can keep moving along. It says purchases of direct materials, 80,000. Okay, we purchased, and on the left, 80,000 of materials. So we've now accounted for all of that. Direct materials used, 60,000. So when we use direct materials, out on the right and on the left of work in process, okay, out on the right and on the left, direct labor, 40,000. Direct labor gets added to work in process. Okay? So work in process is where we're adding our direct materials that are used, we're adding our direct labor, and we're adding our manufacturing overhead as well. Okay, so 40,000 is direct labor, all of our product costs. Total manufacturing overhead applied to work in process, 100,000. So that's 100,000 that's added to work in process there. And really it's coming out of this manufacturing overhead account. Again, I'm just going to introduce this idea now, but we talk about this a lot more in detail later. But it's coming out on the right of manufacturing overhead, in on the left of work in process. Okay, then it tells us ending work in process is 20,000. And then we don't know ending finished goods or cost of goods sold expense. Okay, so ending work in process we know is 20,000. So we have enough to be able to start to solve for some stuff. But let's see on the next page. It says using the above information, what is the ending balance of raw materials? What is the cost of goods manufactured? And it says assuming cost of goods sold expense is 100,000, was the ending balance of finished goods. So let's go ahead and take into account some of this information. The first one just says, what is the ending balance in raw materials? So we know that we started with nothing, right? We bought 80,000 worth. 60,000 got used and moved over into work in process. That means that we are left with 20,000. Fantastic. Good for us. I'm done with that one. That was 20,000. Next one, using the information. What is the cost of goods manufactured? Cost of goods manufactured. You might see that and think that that's like a general term, like nothing's, capitalized or whatever. But cost of goods manufactured is very specifically the amount that moves from work in process over into finished goods. So out on the right, in on the left, out on the right of work in process, in on the left of finished goods. That is our X number. And then here's what we can do. Work in process, there's definitely a lot going on here, but we can take this and translate it into an equation. Okay, we can say that our ending balance is equal to beginning balance plus what makes it go up, direct materials, direct labor, manufacturing overhead, minus what left or what went out on the right. Move X to the other side. We've got X plus 20 equals 200. X equals 180. So X is 180,000. That is, our cost of goods manufactured. 180,000. Got a little carried away there. Wanted to have an extra 0, but 180. So assuming cost of goods sold expense is 100,000 for the year, what is the ending balance of finished goods inventory? What is the ending balance of finished goods? So 100,000 is our cost of goods sold. And we know that that's what came out on the right of finished goods because it ended up being sold. We just calculated that this cost of goods manufactured is 180. So we started with nothing. We had 180,000 of goods that were finished. We sold 100,000 of them. So that means that we're left with 80,000. And that's the answer for that. So this is what I mean, that the T accounts are extremely helpful. Even if you're not a big fan of T accounts, I like them a whole lot when it comes to this. And then translating those T accounts into equations is a lot simpler than what you could do. You could use the T accounts, or you could use these formulas, relating beginning work in process. We were adding the stuff to work in process to then get to cost of goods manufactured. And then with finished goods, you could say, okay, beginning finished goods plus cost of goods manufactured is cost of goods available for sale minus ending equals cost of goods sold. Again, you could use these equations, but I think that starting with your T accounts, being able to visualize what's going on, and then translating that to these equations or to these formulas, I think is the far easier approach, and you're going to make way fewer, many fewer mistakes. Okay, that's it for this. So we've introduced that idea of the T accounts for our inventory accounts. So thank you for joining. We will keep it moving in other videos. But for now, I want you to have a wonderful day. Thanks for watching that GPA Factory video. Hopefully that was extremely helpful. If you found it to be helpful or to kind of clarify some of that content, you can also have access to a free month of membership if you follow this link and use the code YouTube100. Now, with the GPA Factory membership, you'll have access to weekly review sessions that are 1 to 2 hours posted every single week that come with practice questions to help you along with your studies and have video solutions to those. In addition, it'll include an exam review as we get closer to the exam that'll have even more practice questions and video solutions to those given out as well. You also have 24/7 access to our question wall if you get stuck while you're studying, and you get discounts on private tutoring. So if all of that sounds great, again, go to this link and use the code YouTube100 to learn from one of the best to ever teach this course. That's me. So try it out, see if you like it, and yeah, we'll see you around. Thanks.